Good afternoon. It's my pleasure to welcome you to this afternoon's event on whether or not the Fed is behind the curve. And it's my particular pleasure to welcome our panel of real experts who are exceptionally well qualified to discuss this important and timely topic. In the order in which they'll speak, they are Don Kohn, the former Vice Chair of the Federal Reserve and currently the Robert Ruser Chair in International Economics at the Brookings Institution. Bill White, who, amongst other things, was Chairman of the Economic Development and Review Committee at the OECD, and who famously foresaw the 2008 Great Economic Recession. He'll be followed by Nathan Sheets, who currently is the Global Chief Economist at Citibank, and who formerly was Undersecretary of the Treasury for International Affairs. I'll be the last speaker on the panel, and my good friend and former AI colleague, Alex Pollock, will moderate the discussion. It would seem to be a particularly opportune moment to discuss the topic of the Federal Reserve. Considerable progress has been made in regaining inflation control. The Fed has started an interest rate cutting cycle, and major challenges face the Fed as we look towards 2025. As to the progress that the Fed has made, contrary to the expectations of most economists, the Fed has succeeded in bringing down inflation from a multi-decade high to close to its 2% target without causing a recession. Indeed, the economy continues to grow at a satisfactory pace, and unemployment remains at very close to its post-war low. The moderation of inflation and signs of a cooling labor market have allowed the Fed to start an interest rate cutting cycle. At its last meeting, the Fed cut rates by 50 basis points and signaled that a further series of interest rate cuts were in store. Markets have reacted well to the start of this interest rate cutting cycle, with the stock market taking out new record highs on practically a daily basis. As we look ahead, the Fed faces a challenging monetary policy setting. At home, it appears that there is a slow-motion commercial property train wreck in progress that could cause a wave of small and medium-sized bank failures. At the same time, it appears that whoever wins the November election, the Fed will have to deal with very large budget deficits and a soaring public debt. Meanwhile, if Donald Trump wins the election, the Fed could have to cope with an international trade war if Trump implements his campaign promise to place a 60% tariff on Chinese imports and a 10 to 20% tariff on imports from the rest of our trade partners. The risks from abroad also appear sizable. We have ongoing wars between Russia and Ukraine, and between Israel on the one hand and Hamas and Hezbollah and Iran on the other. The latter war could have major implications for the world energy market, particularly should there be disruptions to the flow of oil through the Straits of Hormuz. At the same time, we have clear signs that the rest of the world economy is slowing. China is having to cope with the bursting of its housing and credit market bubble, while Europe is having to cope with a slowing Germany and an over-indebted France and Italy. All of this raises a series of questions that I've asked the panelists to address. Firstly, in the run-up to the inflationary surge in 2022, the Fed was very slow in raising interest rates. Might the Fed be making a similar mistake now by being too slow in cutting interest rates to address a weakening economy? Second, the Powell Fed has been characterized by its backward-looking and data-dependent approach to monetary policy. Is this the appropriate way that monetary policy should be conducted? Third, at the start of last year, we had a regional bank crisis that required heavy Fed intervention. We now seem to have a slow-motion commercial property train wreck that could cause serious problems for the small and medium-sized bank. How serious a problem is this for financial stability? Fourth, even before the lavish budget promises being made on the campaign trail, the Congressional Budget Office has been warning that the country's public debt is on a path to exceed its level at the end of the Second World War. What are the implications of fiscal profligacy for the dollar outlook and for monetary policy? And finally, what would be the Fed's appropriate monetary policy response to a spike in the international oil price? So this is quite a number of questions at an interesting time. And without further ado, I'll ask Alec to start moderating the discussion. And I'm very much looking forward to hearing what my co-panelists have to say. Alex, the floor is yours.
Thanks, Desmond, as always, and thanks for inviting me to join this panel. And let me add my welcome to all those who are joining us for this most timely discussion. The Federal Reserve, in its ongoing challenge of correctly fixing prices in the interest rate market, and all of us trying to think clearly of what is coming next, always face, as our colleague Bill White and I agree, recursive complexity and inescapable uncertainty. But we have to try anyway, needless to say. As Chairman Powell so brilliantly said, we're navigating by the stars under cloudy skies, and we seem to have an English climate where the skies are always cloudy. Desmond has thoughtfully laid out many of the key factors in considering whether the Fed is behind the curve. I want to add a few reflections to that before we start by way of introduction to our panel. Desmond notably mentioned wars. We should remember that the most important events in financial history with the biggest impact on economics and finance are big wars. And as we know, we got two sizable wars going at enormous cost already, but they could get a lot bigger with serious consequences. The election, as Desmond said, and its outcome is always relevant. The Fed is always, in fact, in the midst of shifting political winds and has to cope accordingly. We've got the collapse of the Chinese real estate bubble. By one estimate, China has 90 million empty housing units. And I just want to say this reminds us that even building empty apartments whose value will soon evaporate to zero counts as increasing GDP while you're building them. Should give us pause, as obviously it did for China's GDP growth. We have the big bust, as Desmond said, in US commercial real estate, record vacancies in office space will become loan defaults and loan losses. And this reminds us that the collateral for a real estate loan is not the real estate. It's the price of the real estate. And the price of real estate tends to drop further than even our most pessimistic scenarios thought possible. Of course, we have to worry about inflation. We say inflation is down, by which we mean average prices are up, but rising less rapidly. I recall that we're only a little more than a decade into the formal doctrine that the Federal Reserve should commit itself to perpetual inflation. And it seems to me that whether that doctrine is sustainable over a long run is still unknown. Then there's gold. We've had the remarkable bull run in gold to over $2,600 an ounce, which I note is 75 times the famous former official fixed price of $35 an ounce. Does this gold market portend a growing de-dollarization, as is suggested? Does it mean a lessening of the US dollar's exorbitant privilege and thus more pressure upward on interest rates to finance the growing and persistent U.S. budget and trade deficits. I want to mention the Fed's own finances. Desmond talked about the Fed's balance sheet. I add the resulting huge operating losses of the Fed, which, if you didn't notice, last week passed the remarkable sum of $200 billion in cash operating losses at the Fed, and these losses continue to grow, and these are taxpayer costs without legislative approval or appropriation. And finally, there's the issue of data dependence. Any decision about the future must obviously mix some kind of theory with the data, since the data from the past only has meaning in the light of some kind of theory. Data dependence was meant to focus on long-run trends as opposed to daily squiggles of data, but the whole problem we face, isn't it, is to pick up when the trend changes direction. So to say, when does the curve curve? And is the Fed getting that right? But we have an outstanding panel to take on such issues today. They'll each make opening remarks of about 15 minutes and speak, as Desmond said, in the order of Don, Bill, Nathan, Desmond. Then we'll go back through the panel in the same order. So each panelist has a chance to react to the others or clarify points or change his mind if he wants to. We'll then move to a general discussion, including questions from the audience, which you can submit electronically as described in the conference invitation, and we will adjourn promptly at 4 o'clock. So is the Fed behind the curve? And where is the curve curving to? And Don, you have the floor.
Thank you, Alex, and thank you, Desmond, for organizing this. Great to see old friends again and participate in a good discussion with them. So no, I don't think the Fed is behind the curve, though. I'm going to try and answer a whole bunch of these questions until Alex gives me the hook and see where we get. I think, and I'm going to combine the first two. So the first one was, is the Fed behind the curve? And the second one was about relying on projections rather than pieces of incoming data. And I think they were at risk of falling behind the curve. I thought I was concerned about that, but I think after September, they've kind of caught up. And one can ask, and this is where I'm going to get into the second question about projections and data dependence, how that might have occurred. And I think there were two things that were making them somewhat hesitant to begin backing off the restrictive monetary policy they adopted. One was a risk management. We came out of a very high inflation period. I think a really bad mistake would have been to ease off too early. The costs of doing that and reigniting inflation and moving it back up would have been very high. So I think they were appropriately cautious about moving to ease policy, given the history of the last 4 years. And the second one is the one, Desmond, that you put your finger on and Alex discussed, which is the data dependence versus projections. So I think we came through a period in which the Federal Reserve and many economists, myself very much included, maybe other people on the panel not so, lost confidence in some of their ability to project. These projections during 2021 in particular of inflation were really bad. Remember transitory and all that discussion, and we've discussed that before on this panel at AEI. We've had good discussions. But I think once you go through a period in which your forecasts aren't very good, you do lose confidence in those forecasts. And we have to remember just how unusual this period was. We don't get global pandemics and shutting down economies except once every 100 years or so, let's hope. And so there's not much precedent for how to figure out where the prices, where the costs are, what's transitory, what isn't transitory. So I think the Fed lost confidence in their forecasts. They waited until the incoming data were pretty definitive before easing policy. But I think they're making a transition, I hope, and I expect that they are in the process of making a transition to more forecast-based policy. So I agree. Best practice monetary policy is forecast-based. Alan Greenspan used to say this all the time, and he also said, we're going to make mistakes in our forecasts. And I think you have to be ready to admit that. But he said, Greenspan used to say, but we will correct those mistakes as quickly as possible, and we will always keep our eye on the legislative mandates for the Federal Reserve, price stability and maximum employment. So I do think they're in the process of transitioning. The fact that they started easing while the inflation on a year-over-year basis was still over 2, and the PCE deflator that they use, the chain price index that they like to use, suggests that they were basing it on a forecast. So I think they're making the transition back in what are more normal times when we've gotten out of this unusual COVID period. So I think it was reasonable for them to have this confidence and start easing. The data were suggesting that inflation was coming down and coming down pretty quickly, even though it's still over 2%. The labor market roughly in balance. The unemployment rate had risen. People weren't quitting their job. The Great Resignation was over. People weren't quitting their jobs. In fact, quits were below where they'd been pre-pandemic, suggesting the workers perceived the labor market not tight and more normal. Businesses weren't laying off people, but they also weren't hiring at a great rate. So and wage increases were slowly declining. Wages are a lagging indicator, and wage increases were slowly declining. So I think it was correct for the Fed to say our best judgment right now is the labor market is approximately in balance. You take a labor market in balance, you keep inflation expectations anchored around 2%, and they were. That's one of the remarkable things about this period. We had inflation up at 7, 8, 9% on some measures, and long-term expectations remained anchored. And I think that's a tribute to the performance of the Federal Reserve from 1980 through 2019, keeping and putting inflation down and keeping it down, and a tribute to the Powell Federal Reserve that when it recognized it had gotten behind the curve on inflation, it moved very, very aggressively to deal with it. So you have a balanced labor market, expectations pretty well anchored at 2%. I think there's every reason. Wage increases slowly declining. I think there's every reason to expect that inflation would continue to go down. Now, the other question might be, after the very strong September data, did they make a mistake cutting rates? So the premise of this, the title of this session might be, are they ahead of the curve, not behind the curve in cutting rates? And I don't think so. I mean, I think for the reasons I just stated, the labor market, inflation expectations, et cetera, I think the 50 basis point September cut was really catching up with where they should have been. But I think they should be very cautious and careful going forward. And I think there are a couple reasons for that. One is aggregate demand has been quite resilient. The economy is growing pretty rapidly for policy being so restrictive. Estimates of the third quarter growth are 3%. Second quarter growth was 3% at an annual rate. So the economy is growing at or beyond its potential, and the tightness of monetary policy wasn't really having a damping effect on demand. Now, one reason for that is markets expected rates to be cut. And so financial conditions, the equity market, bond prices, et cetera, reflected that. So to some extent, the expectations made made the aggregate demand stronger. But it's a tricky question about the intersection of actual policy expectations and this resilient aggregate demand. Some of the factors making aggregate demand resilient, the investment demand and for AI and things like that, I think are not really going to respond to interest rates very much. So aggregate demand is resilient. And I think the other point that would make me cautious about the pace and amount of rate cuts going forward is I suspect that they're going to end up at a much higher rate or considerably higher rate than they were at going into the pandemic. I think there are a number of reasons to think that the equilibrium rate, the rate that balances aggregate supply and demand, is substantially higher today than it was in 2018 or 2019. You've got the very large deficit. You've got that investment demand. You've got consumers have the wealth. Household wealth is very high and it's supporting consumption, and you have government spending. So I think if you look at C plus I plus G, there's things supporting them in addition to the easy financial conditions. So I think they need to be careful going forward that they don't overreact until they get some information that the previous tightening has been more restrictive than it appears to have been. So that covers questions 1 and 2. Let's think a little bit about this commercial real estate problem. And it certainly is a problem. It's not only office buildings, but a lot of retail establishments are vacant and prices of these things are going down. We don't know where all the losses will come to rest. So obviously they'll rest on the people who own the buildings to some extent. These were presumably not 90% loan to value, but there are loans out there. You can have seen this coming for some time. So banks should be protecting themselves as best they can. There may be limited ways to do that. And the supervisors, I think, are leaning all over the banks. So particularly after March of 2023 and the disorder in the regional bank markets and that caused them to trigger systemic thing, I think the supervisors are all over the banks. And then the other aspect that gives me a little bit of comfort or a little, I think, interesting part of this is the Fed has moved very smartly, in my view, to shore up the role of the discount window as a lender of last resort. So this is not, banks don't like to borrow from the discount window because there's stigma involved with this. And in the case of Silicon Valley Bank in particular, and some of the others, when an emergency occurred, they couldn't borrow because they didn't have the collateral pre-positioned and they couldn't get it there. So the Fed has moved to force the banks to pre-position collateral, to test those lines, and to test their liquidity stress tests much more forcefully than they did before. So I think you can't ever say there's no chance of a systemic event here, but I think there's been preparation. Whether it's sufficient, I guess we'll see over time. So I don't think I can reassure Desmond that there's no problem, but certainly people are working on it. The federal deficit is the fourth one, I guess, isn't it? So I think this is an important point, and I'm glad Desmond raised it. With debt to income rising, and suppose we have divided government, and then some of these promises can't be kept or won't be kept. But still, debt to income is rising. The demographics are there. It's at a very high level. And interest rates are higher. And if I'm right that interest rates aren't going to come down to where they were before, then the old bailout of interest rates are lower than the growth rate, you can grow yourself out of a high debt to income won't be available or be less available, and they'll have to pay attention to the primary deficit. I think this is a situation in which debt service is going to becoming a much larger portion of the deficit. And I think as a consequence, both Democrats and Republicans will be pressuring the Fed to keep interest rates lower, because higher interest rates will just add to debt service burdens. It will interfere with their ability to get their favorite tax cuts or spending plans done. And so I can see pressure on the Fed, political pressure on the Fed, whoever wins the election, being more intense over the next 10 years than it has been. Having said all that, I do think having one of the candidates, the former president, say he wants a say in monetary policy is very dangerous. And I think we know from history, when presidents want a say in monetary policy, the say they want isn't raise rates to stop inflation. The say they want is lower rates to boost the economy to get me or my colleagues in my party reelected at the next election. And that's the reason Congress tied its own hands and tied the hands of the president in influencing monetary policy. So I think I'll end by saying that I think it's really important under these circumstances to protect the independence of the Fed, to honor the independence of the Fed. As the current situation now stands, the main way the president can influence the Federal Reserve is through his or her appointments to the Fed. The Senate has advise and consent. The Senate must approve those appointments. So I hope that the Senate and the president will come up with reasonable people who are willing to continue the kind of technocratic expertise, the arm's length relationship of the institution from the political system that's existed really since 1979. I'll conclude with that. Thank you, Alex. Thank you, Desmond.
Thank you, Don. You certainly make a good point that there is a lot of historical precedent where presidents don't want to control the Fed. We could tell a lot of good stories. My favorite one is at least in one version, Lyndon Johnson physically shoving William McChesney Martin around the living room of his ranch while he was shouting at him about interest rates. So I think you're right. The Fed is going to face that one way or the other, I guess. Anyway, Bill, your turn.
Thank you very much, Alex. Like John, I'm really pleased to be here with some old friends. I guess we're going to have a very interesting discussion. Desmond, I'm not going to follow your 4 questions directly. I've got a bit of a different framework that focuses specifically on, is the Federal Reserve behind the curve? But I'll be touching on a lot of those questions that you raised as I go through this little presentation. I'm going to say some stuff that I hope will be new, and in fact relates to the questions that you've asked. But I'm going to say some stuff that's old as well, in the sense that I've got a rather longer term view about the strategy that the Fed and central banks should be following. So it's not just sort of the tactical issues of what happens in the course of the next couple of quarters or even the next couple of years. I'm worried about some longer term trends that I think the Fed and the central banks have actually seriously underestimated and put us in the delicate position that I think we now find ourselves in. Well, next slide, please. Sorry, next one, please. Let me start off with something that sounds hard, but it's not really. Just one slide, a fundamental epistemological error. I think that the central banks have actually made a collective mistake in assuming that the economy is a simple static system, something that is understandable, that's controllable, that is linear, that can be represented by a few simple equations. I think the problem with that belief is that it's just wrong. And that in contrast, that the economy is actually a complex adaptive system. And these are kinds of systems that have been well studied by other disciplines. And they're actually very different in the way that they operate. And not least of which is that these complex adaptive systems have a tendency to break down. They are highly nonlinear in the way that they evolve. They're constantly changing. And recognizing that has profound implications for the conduct of monetary policy. So if you think about the economy as simple and static, it's essentially like a machine. It depends on oil and gas. But complex adaptive systems are much like a forest. So when you want to think about it in terms of an analogy, if you think about it like a machine, you have to regulate the oil and gas. But if it's a forest and you throw oil and gas on it, it's not likely to do it very much good. And I would just give 3 very concrete examples. One of them in these complex adaptive systems is that optimization is impossible. Trying to get the last dollar of GDP out of the system with a short-run approach toward it is going to be counterproductive. The best you can do is to try to avoid really bad things happening. So I think we need that change in mindset. In these complex adaptive systems, the problem doesn't arise from something outside going wrong, okay? It's the insidious buildup of internal imbalances that basically lead you to a tipping point that can be really quite disastrous. The last point that I'd make about these systems is that Don talked about forecast errors, okay? The Fed, I think, has had inflation by their target definition below the desired level prior to the pandemic, 23 out of 26 years. And in most of the instances, then immediately forecast they'd go back to where they thought they should be. And it never happened. And the IMF did exactly the same thing after the great financial crisis. 10 years of making wrong forecasts about the next year and then having to revise. So our forecasting capacity is essentially zero. And I think it's very important that we recognize that. Next slide, please. Are we behind the curve now? Okay, let me take a shorter term perspective like Don has and like most people do. There's a whole range of reasons, and Don has run through some of them. I'll be very quick about why we should say that we do in fact need aggressive easing at this point. And I know this sort of goes along with stuff that Desmond has written in the past too. I guess the first argument would be that the full impact of unprecedented earlier tightening has yet to be felt. Well, I can't disprove that, so take it as that's a good argument. The policy rate is well above R star, the neutral rate that Don referred to. And I guess when you look at the policy rate, that's true. If you think about R star is somewhere around 3%, clearly we're well above that. Inflation is not a problem. It has been going down sharply. It will continue to go down sharply. And that justifies a pivot. Fed's got dual mandate to labor markets that they judge to be not so much weak as likely to get weak. Okay? Another argument, undershooting inflation is more dangerous than overshooting. Now, there's an absence of symmetry in the Fed policy under that flexible average inflation targeting, okay, that really leads you to that conclusion. And if you go further back in history, the concern about deflation has always been extraordinarily strong in the United States, at least. And I say not especially in countries like Germany. So we've got all of these arguments for saying we need aggressive easing. And the last one in that slide is, and again, reference has been made to it by Desmond, weakness in China and Europe will export deflation to the US. There's something to be said for all of those arguments. Next slide, please. But the problem, and this goes back to what Don just said near the end, yeah, they're doing the right thing, but we got to be very careful going forward. And the reason why is that every one of the lines on that previous slide, I can give you a counter argument that says what that argument is not true. So you start off financial conditions, okay? If you look at the policy rate, it looks high. But if you look at measures of financial conditions like the Chicago Fed Index, it indicates that financial conditions are easier now than they have been on average over the course of the last 25 years. The argument about R-star is enormously difficult to measure. Chairman Powell himself, Don made allusion to the stormy skies and overcast, and so it's very difficult. There are a number of people who would dispute the fact that R-star has actually fallen over recent decades. A very interesting paper by Ricardo Rees, Andrew Smithers, and others, pointing out that if you measure R-star in terms of the rate of return on equity, not sort of what's happened to government bonds, it hasn't gone down at all. And in fact, there's all sorts of arguments that people would give you that it's likely risen. Inflation is going down. It's no longer a problem. In the very uncertain world that everybody's agreed to, that's the way it is. It's very hard to be certain about anything. And there's a whole list of people who say they don't buy into inflation's gone away. And I'm thinking about Adam Posen, Mohammed Al-Arian, Mike Spence, the Nobel Prize winner, and I would add myself. It's not at all certain that we don't have to worry about inflation going forward. There has been reference to the fact that the labor market seems to be weakening. I won't go into the details, but there's a huge number of indicators that say it's not weakening. The unemployment rate's gone up, not because of weakening demand, but because of increased participation rates, more immigrants, et cetera, et cetera. A deflation spiral, a business about we have to worry about deflation more than inflation. I've always thought that was wrong. As far as you look at sort of academic studies into deflation in the past, the Great Depression in the US is the only occasion, okay, almost the only occasion where falling prices have been associated with future problems in the economy. Recent work at the BIS shows that there is, in fact, a corridor of stability with respect to inflation. And that once you get above that corridor of stability, that inflation can take off very quickly. So I would actually turn the whole table around and say we should be more worried about inflation than deflation. In fact, I wonder how we got into worrying about deflation at all when inflation targeting was a response to too high inflation. The argument that global developments, China, et cetera, indicate that we should have easier policy. Well, I think Desmond himself mentioned that all of the geopolitical stuff is actually pointing in the opposite direction. And I would add, as I put on the slide here, that the US is essentially a closed economy in any event. So my bottom line is ease cautiously, if at all. Next slide, please. I guess I want to suggest that in a certain sense, monetary policy has always been behind the curve. That they have given far too little consideration to important aspects of the economy, and in particular the fact that easy money has got longer run implications. So what you do today can be the right thing to do today, but it's going to make your life much more difficult going forward. And I think the way it works is that you have easy money, encourages debt accumulation, it accumulates leverage, it causes resource misallocations, or as Hayek would call them, malinvestments, which increases the severity of the subsequent downturn when it does come. And then the policymakers, this is the problem, the policymakers recognize but they've now got a situation which is more dangerous than it was before, that leads them to implement still more easy money, still more safeguards, which of course just encourages more debt accumulation and more leverage. And so what you get, and this is really Hyman Minsky, the much ignored Hyman Minsky, short-term stability leads to long-term instability. And that, I think, is a real problem. Next slide, please. Going back really to my second slide, okay, but this longer term, you're underestimating the complexity of the real economy and the longer term implications of what you do. The first thing that I would say that the Fed, I think, has done has been a chronic inattention to supply side developments. All the central banks have done this. There's been this near-minded focus on aggregate demand and what it means for inflation via the labor market going forward. And it's not as simple as that. Supply side developments are very important, and they have been underestimated. Think about from the 1990s. This is going back now, what, 30 years. We had the breakup of the USSR. We had the establishment of the euro. We had the market reforms in China under Deng Xiaoping. We had demographics, the baby boomers going through, urbanization in China. All of these were enormous positive supply side shocks that reduced inflation. And the reaction should not have been, it's the same, the disinflation, as disinflation due to inadequate demand. But we eased money regardless, and debt ratios, not only in the United States, but around the world, have been rising inexorably and indeed exponentially for the last 20 or 30 years. We had a similar easing bias during and after the pandemic, and that allowed inflation to rise quite sharply. And I think that is very unfortunate, because we're now in a situation, and I talked about this the last time I was here, so I'm not going to go into it in any great depth. That era of positive supply shocks is now going to be totally transformed as the world moves into a world of negative supply shocks. The demographics are all turning around. Urbanization has sort of reached its limit. The baby boomers are through. The labor markets are falling. Labor supply is falling virtually everywhere. We have climate change to deal with. We have governments that are confronted with increased defense spending, a lot of spending that they will have to do to deal with both mitigation of climate change and adaptation of climate change. Let me just put it that all of the major economies now find themselves facing these negative supply shocks, and they all have an internal debt problem, a debt overhang problem, to which one plausible answer, one easy answer, is more inflation. So I think we have a problem arising from the failure to understand the importance of supply side developments. Next. Oh, let me just say here, the patient fed, the last thing on that slide. This is the data-driven stuff. Wait until you see the whites of their eyes. I totally agree with Dawn. We've got to go back and start thinking about prospective developments. And one particular thing that we have to think about is prospective supply side developments. New slide, please. And this is my last one, Desmond. Or Alex. In the same sort of way, there's been a chronic lack of attention to supply side developments. I think there's been a chronic inattention paid to financial developments. We have allowed, over the course of the last 20 to 30 years, as I mentioned earlier, debt levels, both public and private, to rise to record levels in virtually every country in the world, every major country in the world. But here's the problem, is that those debt overhangs, depending on whether they are private sector or public sector, lead you to very different outcomes. So that if you've got high interest rates that come face to face with very high private sector debts, it seems to me what's more likely is that you get some kind of a private sector collapse, financial instability on the private side, feeds through to the labor market, and then you get a cumulative kind of downturn. And in the current circumstances, deflation. The problem with high public debts is that it leads you in the very opposite direction. That the high public debts, and I think Don mentioned this right at the end of his statement, high public debts lead you to a situation where if you raise interest rates, the debt service starts to accumulate to such a degree that the only way out of it is to go back into the central bank and to get them to print the money. And we have seen this so many times in history. And as Don recognized, the pressure is there, and not just on the Fed, it's going to be on everyone. And it could well be that in China, that we're going to see a very different set of policy responses to their current difficulties than we have seen thus far, that they may be an engine in the future, more of inflation than deflation. So this is a classic problem in complex adaptive systems, is that they have tipping points, and they can tip in one direction or another. My best guide, and I'll finish with this, is I think a near-term problem, deflation, a falling off of government revenues, a big increase in deficits, and then the only answer is the government's got to go back into the Fed and back into the People's Bank and back into the ECB. And the upshot is that at a certain point, people know that something is happening. And what is a bit worrisome right at the moment is you think about the Truss affair in the United Kingdom, you think about some of the developments in the market for US Treasuries. There's a paper that was, I think, very important, presented at Jackson Hole by Professor Lustig and a bunch of his colleagues, that basically made the point that all of the difficulties that we've had in the Treasury market in recent years have actually been associated with new information about what's happening on the fiscal front. And so that as it were, we're starting to see initial indications that people are becoming worried about fiscal deficits and the stock of debt accumulation that they haven't been worried about in recent years. Where to from here? I'm very pleased to say my time has run out, because that is a really difficult question. So I'll come back to that, I hope, in the question period. Thank you.
Thank you, Bill. Very interesting. Just to add one more point, in the potential inflationary outcomes you talk about would be consistent with the behavior of gold in recent times. Let's go forward. Nathan, take your mute off there, please. Yeah. Great to have you with us, Nathan.
Yeah, it's good to be here. And listening to Don and Bill brings back a lot of memories. And I knew that Bill would work in the Minsky moment, so I appreciated that. That was really nice. Well, let me spend a few minutes here, focus specifically on this question: is the Fed behind the curve? I think I broadly agree with Don's conclusion that the answer to that is no. And I would say it really is quite remarkable that we are this far in the Fed's tightening cycle, and to the point now where they're actually starting to ease a bit, and we haven't seen a more appreciable slowing of the economy. And I think what makes that even more remarkable is that if you'd asked me in early 2022 this same question, I would have said categorically that the Fed is behind the curve. They were way too slow responding to the inflationary pressures. And maybe some of that was understandable. Maybe there were other constraints they faced, but they were slow getting out of the blocks. And the implication of that is that they had to hike rates very aggressively over a very short period of time. And that would have put me in a place where I would have said, with high probability, as I was at that time, and many other forecasters were saying, that we will very likely have a recession here. And I think the economy's resilience through this episode is something that bears reflecting on and thinking about. I think there were two special factors that were at work in the US economy. One is this period of very rapid rate increases and higher rates was preceded by a very long period of extraordinarily low rates. And the upshot of that was it gave households and firms opportunities to term out. And in the US, we have these 30-year fixed rate mortgages. And the implication of that is if you look at data on household debt service costs, it's kind of at a historically normal and maybe even a low level. It kind of dipped and it's bounced back, but it's quite moderate. Now, a contrasting case, kind of the other end of the spectrum here relative to the United States, is Sweden. In Sweden, everything floats, both on the household side and the corporate side. And as the Riksbank hiked rates, it throttled the economy. And Sweden's economy really did struggle. Now, the Riksbank, fortunately for the economy, has been able to start easing, and the economy is bouncing back. But this terming out was an exceptional factor. And then a second exceptional factor that was in play is a direct implication of the pandemic. And I think that there was a huge slug of pent-up demand for services that was kind of working its way through the system, and in some sense was offsetting and countervailing some of the Fed's rate hikes. Now, if you want to put that in technical language, I'd suggest that through this cycle, the cyclical or short run and neutral rate was probably somewhat higher than it would have been otherwise. And that's one reason why the Fed ended up having to hike more than they had been anticipated. So putting it all together, my sense is the Fed's not behind the curve. It behooves us to think more about the underlying contributors to the economy's resilience. Now, from a Fed perspective, I'll talk about policy in a minute. If Jay Powell is able to land a soft landing here, and he's able to achieve that, I would say that this is unprecedented and is going to earn Powell and maybe some of his colleagues a place in the Central Bankers Hall of Fame, maybe even an honored place in the Central Banker Hall of Fame. That given that we had such high inflation, Volcker was able to defeat inflation, but it took a searing kind of double dip recession to do it. And Greenspan achieved the soft landing, but the economic conditions were not nearly as complex. Now, turning specifically to the macro, let me make a few points. I am much more relaxed about the inflation outlook. And when I say that, I'm thinking the next few years. We can debate the longer term points, the inflation pressures the bill was emphasizing. I'm also kind of skeptical of that. But in the near term, when I look at the components of inflation, goods inflation has basically returned to where it was pre-pandemic. And I think broadly speaking, the same kinds of drivers, technology and productivity and the like, are in play there, are likely to keep it down. Shelter inflation has been sticky, but at the end of the day, shelter inflation must reflect rents in the economy and house prices, and we have enough indicators of that that tell us over time shelter inflation is going to come off. And then non-shelter services inflation is down some, and the labor market's loosening. We can debate how much. I'll get into that in a minute. but those pressures are attenuating as well. So maybe there's a debate about how quickly we get back to 2.0% inflation, but this really in the next couple of years is not a 3 or 4% inflationary economy. It's, do we hang out for a while at 2.5 or 2 3/4? And then underneath that, there's even a debate about how important is it that we get back to 2.0. I'd say from a Fed credibility standpoint, it's quite important, but beyond that, not so clear. Now, beyond inflation, as I indicated, the labor market is softening. That a number of indicators point to a looser labor market than we had before. But by the same token, I take Bill's point that if I take a snapshot of the labor market and kind of look at it statically and see where we are at the moment, none of those series at the moment scream an outright weak labor market. And so really the debate in interpreting the labor market, in my view, is how much weight to put on the trends and the momentum of what we're seeing versus the fact that the levels of these series and surveys and numbers that we get are really not that concerning. Now, I think that in my mind, what kind of skews my thinking more towards soft landing and putting a little bit of weight on where the labor market is as opposed to the trends is that the rest of the economy continues to look pretty good. As Dawn highlighted, second quarter GDP growth is running 3%. The Atlanta Fed's nowcaster, we've got most of the data for Q3, is a touch over 3%. This is not an economy in recession. This is an economy that continues to perform pretty well. The consumer looks solid. Maybe there's some worries about kind of the bottom 40% of the income distribution. We're watching that. That's a risk. But all in, the consumer sector looks solid. The business sector looks solid. Maybe, again, a little concern about some of the small and medium-sized firms. But whenever I talk to my colleague, who's an equity strategist, they say, what's going on with equity prices? Why do they just keep going up? He says, it's simple, earnings. And I think that that's a reality, that those firms are making a lot of money. And that has financial implications. It also is a sign that the economy continues to perform all right. Kind of putting all that together, I think that it is fair to say now that 12 months ago, all the risks for the Fed were skewed toward inflation. 18 months ago, and they took rates to 5.3 in response to that. Now inflation's down, and those risks are, in my mind, if anything, are skewed toward concern about where the labor market is and potential slowing. That they don't need to be this restrictive. I would characterize the stance that they had as very restrictive, and I think now they're moving to a place maybe around 4%. Which I think of as still being restrictive. I would suggest that over the course of the coming year, that it makes sense for them to be engineering a policy, given what I'm seeing in the economy, that takes rates back to the neighborhood of neutral. And I take all the caveats. We don't really know where that is. My guess at this stage is 3%. Maybe it's 3.5%, but 3 to 3.5%. Which still gives them more than 100 basis points of cuts. Of course, you do it with your eyes open and paying attention to what happens in the economy. But I think that's a reasonable baseline. And that's more or less what I see in the SEP. It looks like I've got about 5 more minutes here. So let me just make a few specific comments on some of the other questions. Broadly agree with Don's assessment on the Fed being backward-looking and overly data-dependent. On the one hand, that's not the way the theory of inflation targeting was envisioned. It was supposed to be medium-term inflation forecast targeting, looking through the cycle, not responding to all the wiggles. But the problem here is all the models are broken down. And you just don't have any confidence in saying, oh, it's going to be okay over the medium term. And, the analogy is, yeah, they're driving looking through the rearview mirror. Why is that? It's because they can't see out the front windshield. It's just too foggy. And so they are in a most unfortunate place there. It's not where they want to be. It's not where we'd advise them to be. But I don't know what else they can do until some of these relationships that have been distorted and disrupted by this extraordinary pandemic cycle we've been through start to abate. And even then, it's not going to be clear kind of which periods you use to estimate those kinds of relationships. I'm a notch more upbeat, still concerned, but a notch more upbeat or less worried about the commercial real estate situation. We have indeed seen some pressures, particularly in office building sector in large cities. The banks are generally well reserved against it. And importantly, our reading on this is that we are now at the point in the cycle where there are some deals that are starting to be done, and the vultures, quote unquote, are starting to pick through some of the rubble. And when that happens, that's often a sign that you've hit bottom. And that's kind of how I would describe commercial real estate in the office building space. It's hit bottom, and it's just starting to come back. Still worrisome, I agree, but I'd be probably a notch less worried than I was 6 months ago. And then in addition, the Fed's cutting, and that's going to be helpful for valuations in the sector. And then let me finish with the word on the Chinese economy, since neither Don nor Bill have commented. And I know that Desmond will want me to say something about it. So very much agree with Desmond's assessment that there are deflation. Deflation may be a little grandiose for the inflation problems in China. Let me say disinflation, a sustained disinflationary environment. I think it's too early to talk about deflation or Japanification for China. I think that's overstated. But there is a serious issue where they just have a lot more supply than they have demand. And when the economy hits soft periods, they stimulate supply. And it's a sustained output gap as a result of that. We're watching these stimulus measures that have been announced. It's monetary, it's housing, it's support to the equity markets, and all that's well and good. I think that the markets, and what we're watching most closely now is when they're going to announce fiscal and what that's going to look like. Our sense is that that's likely to be on the order of 3 trillion renminbi, couple of percent of GDP, so significant stimulus. Markets are looking for that to get up to 10% of GDP. And we think that that's possible over a year or two period. And that would be a substantial additional jolt to demand and would address some of these disinflationary kinds of pressures. What other kind of unintended consequences might arise as a result of that, we can talk about it. It would really depend on what that stimulus looks like. But at a minimum, we can say that the outlook for the Chinese economy is unlikely to be a key driver of kind of cyclical weakness in the global economy over the next couple of years. And with that, I'll stop and give it back to you, Alex.
Thank you, Nathan. Very interesting comments. And as somebody who spent a fair amount of time in housing finance, I think you're right about the importance to the household sector of those long-term fixed rate mortgages. The other side, of course, the households are short those. The Fed itself is very long those, and with very interesting results that I mentioned before. That brings us to Desmond.
Thank you, Alex. I'll just get up my PowerPoint presentation. Yeah, coming last, I can say that I really agree with a lot of what the previous panelists have said. In particular, I agree with the point that the Fed should be forward-looking. They should be doing projections. But at the same time, I very much agree with what Bill said, that the economy is awfully complex. And I think that we're at a point where there are a huge number of uncertainties, I would say an unusual number of uncertainties that face the economy in 2025 and that make it really very difficult for monetary policy setting. So just in terms of where I think the weaknesses of the Federal Reserve are, it's like we've said before, they're paying far too much attention to being data dependent. It's backward looking. It seems to miss the point that Bill alluded to, that monetary policy operates with really long lags. And if you wait until you see the things, the white of the eyes, you've waited too long. Monetary policy takes a long time to work. I also think that the Fed hasn't been paying enough attention to financial risks that are developing, and they don't seem to look at what occurs abroad. And I think that there are already very big things going on abroad. What I want to move to are the risks, and I think that it's worth dwelling on this because they're real risks, both domestically and those abroad. So the first of the risks is the real estate, commercial property train wreck that's going on. You just see vacancy rates going up. You see property prices coming down 50% or so. And the question I've got is, what is the implication of all of that for the banking system, largely for the small and medium-sized banks? And are we going to get another Silicon Valley Bank kind of episode? And I would say that it's difficult to see how we avoid it. This chart just shows the amount that the banks have on the hook for. They've got something like $1.7 trillion exposure to commercial real estate. The regional banks have something like 20% of their portfolio is commercial real property. Now, what's occurring is that a lot of the loans are going to be falling due over the next 18 months. The estimates are something like $1.5 trillion comes due the next 18 months. So the question is, how are the banks really going to handle that? We've heard that they've got provisions, but what is of concern to me is that at the same time, the fact that interest rates have been higher than the banks anticipated, they've got huge mark-to-market losses on their portfolio. My colleague here at the AI estimates that you could be talking about $1 trillion, with the Treasury, 10-year Treasury yield at 4%. So they're getting hit by two ways. That the commercial real estate, you're going to get a bunch of defaults, and then they've got mark-to-market properties. So I see studies that say that you're going to see something like 400 small and medium-sized banks failing. That is something I would think the Fed has to take into account, when it sticks to a very high interest rate policy. If they err on the side of too high, you could be inviting a financial crisis. The other uncertainty that the Fed's got, is the federal deficit that we've talked about, and that cuts in the other way, that if you've got a big federal deficit, you'd expect interest rates to be higher, R-star would be higher. And the thing is that we're already running a deficit around about 6-7% of GDP at the peak of the cycle, when the economy is strong, when we should be in balance. And we've now got the two candidates, whoever wins the election, the one is going to be blowing the deficit up through increased spending, the other through cutting taxes. But the end story is that that is really going to be a big uncertainty, a big challenge for the Fed. This chart just shows the debt that we're well on the way to being at levels that we were at the end of the Second World War, and it's difficult to grow our way out of that debt. So you've got, that would be the second domestic problem, which is huge from the point of view of monetary policy setting. Then you've got to take into account that you've got a bunch of external risks. Alex mentioned the notion that you've got two wars. We've got this Israel war, now it's with Iran. Who knows what that is going to do to the oil prices? We might find that out later on this month, but the Fed has to take into account that there's a good chance that you're going to be getting oil prices spiking. So that's another huge layer of uncertainty, kind of like just makes Bill's point that you really can't just run this thing in a mechanical way. You've got to make some kind of estimate as to what is occurring. On top of that, then we've got Trump, should he be elected, what is a 60% tariff on China's goods and a 10 to 20% tariff on the rest of the world? Is that going to be taking us to a world in which we get retaliation, we get beggar thy neighbor problems? Who knows what that occurs, on top of which Trump is going to be providing a supply side shock, if he does what he says he's going to do, deporting a whole bunch of undocumented workers. I'm not sure what that does to food prices. So you've got that problem as well. Added to that is the whole Chinese situation. This chart just reminds us that China has had a huge debt bubble, that basically what you've seen is Chinese debt in a 10-year period increases by 100% of GDP. So the notion that you could get a Japan-style situation in China looks very real. What do they do? Are they going to be exporting their deflation abroad? That is another issue that the Fed needs to address. This is just showing Chinese property prices, in deep decline. And then to the point, Nathan, it looks like from this chart, that China has indeed had deflation the last 5 quarters. If you look at the GDP deflator, so that is another problem. Added to that, we've got the story in Europe. The debt levels are moving in the wrong direction. This chart from the IMF shows that France and Italy have now got situations that are worse than they were in 2010, and they've got large budget deficits. I mean, certainly France has got a large budget deficit and it's ungovernable. So where does that all lead to? So in short, I think that the Fed's got no alternative but to look at the future. I think it's far too early to say whether or not the Fed has nailed a soft landing. We'll only find that out in next year. My conclusion from all of this for the Fed is that the Fed really needs to be forward-looking, that instead of providing a forecast, they should be providing a range of forecasts, telling us what the risks are to the forecast, that acknowledging that, you're in a world of great uncertainty. The interest rate dot plots, to me, don't seem to make much sense. And then finally, I very much agree with Bill that what we often do, the Fed, what it often does is it solves a short-term problem, but only by setting us up for the next financial crisis. That they're far too ready to be buying bonds on a massive scale. I still don't understand what they were doing in 2021, buying $120 billion of bonds a month, at a time that the stock market was on fire and the property market was on fire. It escapes me what they were doing, but we'll see how this all ends out. So Alex, I'll end my comments there. I'm just reminded, of the story with Kissinger asking Chou En-lai, I think it was, what he thought about the French Revolution, and he said it was far too early to draw definitive conclusions, and I think the same thing with the soft landing.
Thank you, Desmond, and thank you to everybody for really interesting presentations. On the tariffs, I don't know if you remember, Desmond, I used to have in my office portraits of Senator Smoot and Congressman Hawley up on my wall, thinking about 1930 and the tariffs. And they were both extremely respectable gentlemen, operating with very good intentions, but a bad forecast. So we remember the dangers of forecasting. I want to go back through the panel in the same order, and 2 or 3 minutes each. Do anything you'd like to add, reflect on others, or expand on. And so you first, Don.
Thanks, Alex. And those were very interesting comments, and I really enjoy hearing Bill again after all these years. And he warned us about financial instability before, and he's warning us again, and was right before, and he could well be right this time. I think one question for Desmond and Bill: what does this imply for monetary policy? So my sense, Bill, coming out of your thing, and you left sort of an open thing at the end. So how would you vote at the next couple FOMCs? So my sense, Bill, was that you'd probably want a bit tighter policy to discourage people from having debt. At the same time, you implicitly criticize the Fed for missing their inflation target. What was it, 23 of 28 years or something like that? On the low side, I would think whatever you did about debt would pile up more years of missing on the low side. So it's not clear to me what you want the Fed to do in monetary policy going forwards. You can say they've made mistakes in the past, I get that, but now we are where we are. What would you have them do about this situation? I do think the Federal Reserve understands that this is a complex system that does adapt. I think they pay a lot of attention to financial stability and what's going on in other countries. Nathan ran a whole division for years, whose main task was to tell the Board of Governors and the FOMC what was going on in other countries and how that would affect the U.S. So I guess that's one point. And I do think, for example, Bill, this whole risk management approach that Alan Greenspan started, but others have taken up, is a little is your mini max thing. So what would be the worst outcome, the most costly outcome to society? How can I protect against that? So I think the Fed isn't quite as out of it as you imply. So I don't have any quarrels with or any points on Nathan's thing, except maybe about China. So I was there 4 weeks ago. This was before the new stimulus was announced, and I would say it's a very gloomy place economically. And it's not only the short-term stuff that Desmond pointed out, the crashing property markets and a lack of aggregate demand to fill in behind the property bust, which unfortunately could be net exports with subsidies, which will just emphasize that trade war problem. If they're trying to keep aggregate demand up by exporting and subsidizing exports, that's got a problem. But I think from the longer term perspective, it was pretty discouraging. I mean, entrepreneurs are discouraged. They're leaving the country. they don't leave the country, they can be thrown in jail if they get too prominent. And the whole thing sounded very dim. So I don't know. In an era in which we're kind of disconnecting the US from China, I'm not sure how much spillover that would be, but there would be some spillover for sure. So I think the China thing is still there. They've taken steps. There's more steps to take. On Desmond, range of forecasts, you get a range of forecasts in the SEP, right? In the Survey of Economic Projection, it gives you a range of forecasts. What it doesn't give you is how the forecasts are linked by individuals. So I think the GDP and the inflation and the monetary policy aren't linked. And a number of people have suggested that might be helpful to do that, but there is a range of forecasts there. Bernanke's suggestion to the Bank of England, they do scenarios. I think people are thinking about that, and how to implement that is not easy. But I do think that's the thing, and I do think they need to. I hope. Last point on Desmond, I hope that you are critical, and I think in many respects appropriately so, of the way they ran QE in 2020 and 2021. And I think there were a number of problems there. They started with a market functioning QE. It morphed into monetary policy QE. They kept buying those MBS mortgages in the summer of 21, the real estate market was on fire. They said they wouldn't raise rates until they were finished buying. So the QE delayed, the forward guidance on QE delayed the increase in rates. So my point here is that in their framework examination that they're doing this year and next, they've said this is an examination of strategy, tools, and communication. And I really, really hope, and I've urged publicly and privately, that tools be part of their exam. I think they need to look very carefully on what they did with QE and with the forward guidance on interest rates. I think it's useful. It's necessary at the zero lower bound, but I think they could. There are lessons to be learned. Thank you.
Thank you, Don. Bill. Got to take off your mute.
Thank you. I'm sorry. On Don's point, I guess what I'm really worried about at the moment is the debt overhang, and easy money is just kicking the can down the road one more time. And the question is the real question, and I have no answer for this, is what can be done to ease the problems associated with the debt overhang? And there, I guess, when you go back into the literature, I mean, what are you left with? You're left with structural reforms to try to increase real growth. You're left with tighter fiscal, I guess, to try to reduce in the measure that you can the degree of debt that is, I think, as Desmond pointed out, I actually was shocked at that chart, the way in which the deficit as a proportion of GDP is getting bigger and bigger as the stock gets larger and larger. And of course, the exponential end of that whole process is it's hyperinflation. You know, that's the Latin American solution. And that, in a certain sense, is where you end up inevitably, unless you can do something about this. I do think we need more attention to debt restructuring and to stop the banks and others from continuing to lend money to zombie companies that are basically sucking out productivity and creating financial instability or potential financial instability as they go. So it isn't just a question of monetary policy. It's a question of trying to deal with the underlying problems that have built up over very, very long periods of time. All of that stuff ultimately is going to take political will. And you guys in the States know far better than I, as a Canadian, that is very unlikely to happen. I did have a few sort of more general points. I guess the one thing that I've taken away here is that everybody sort of is saying, you know, the glass is half full, the glass is half empty. You know, should they ease, should they, sorry, aggressively or not aggressively? And everybody's sort of saying, well, on the one hand, on the other hand. And I was reminded of a wonderful line from Malcolm Gladwell, who's Canadian, who said, you know, people say the glass is half full and others say the glass is half empty. But an engineer wants to know, does the glass have to be so big? And what I mean by that is you do have to go back and ask about the framework of analysis. And that's, I guess, the essence of what I've been trying to say about this complexity thing, is that we have not, and we must inevitably run the economy in a different way, recognizing how little we actually know. And the problem, of course, is we've got to get over where we are. We can't put in a new system and a better system. The first thing we've got to do is get out of the mess that we've got ourselves into. And that's going to take a wide range of policies. My bottom line, I think, is I fear none of that stuff is going to happen. And that in the end, what the governments, all the governments, not just the US, but China, Europe, rest of them, we're going to move to a world of financial repression, because it is the least painful of all the painful ways out of it. And I think that's in the end where we're going to go. So I certainly hope I'm wrong, but when you look at the numbers, I think that's where this is all going to end up. On Nathan's point, where he's less worried about supply side things, you know, not now. And I'm reminded of Milton Friedman's famous line. People said money drives inflation only in the long run. And Milton Friedman said, I've seen the long run, and it's not. And when you look,
it always does get here, doesn't it?
Yeah, the bill does get here. And I mean, the best example, I've given you that whole list of, you know, globalization turning into deglobalization, the demographic collapse, the environmental collapse, the new focus on resilience as opposed to efficiency. The list just goes on and on of all of the things that we have to face. And I just use hurricanes, okay? That you just think about what the US is facing right at the moment. And there's going to be huge costs associated with that. And not 5 years from now.
That gets us to about the end of your time slot here, Bill.
Sorry, finished?
Yeah, if you have one more point, go ahead.
Well, Nathan made the point that all the forecasting models have broken down. Well, Jean-Claude Trichet made that point in 2008, okay? And I'd make the point that the models are broken down because they were never good for anything in the first place. And we've got to recognize that uncertainty, go to scenario analysis, as difficult as it is, tell plausible stories, and make sure that we have some kind of an answer in place should any of those plausible stories materialize. And we don't know ex ante which route we're going to go down when we hit the tipping point.
Thank you, Bill. Thanks. Nathan.
Well, thanks. And I'd say that the forecasting models, if they were broken in 2008, they're even more broken today. So in any event, our friends at the Fed, and I think Don made this point as well, have really struggled with their inflation forecast. You know, at some points over the last couple of years, you've had the SEP inflation forecast, and in the minutes, they've had an inflation forecast that's been dramatically different. And as often said, inflation is going to quickly abate, and just highlights the difficulty of forecasting with models and frameworks that the staff has long relied on. On the medium to long run, and let me kind of frame that as 5 to 10 years. Beyond 10 years, Bill, I'll kind of see that's beyond what I can see, with all due deference to Friedman, who was more of a visionary. But over that period, I'd say for the US, and I think ultimately globally, I'm bullish on productivity, that I think we are on the precipice here of an AI revolution that is going to be at least as powerful, if not more so, than the dot-com period of the second half of the 1990s. And, you start digging into all the implications of that and how that's going to transform things. Truly, truly first order effects. And then similarly, I think that over a 10-year horizon at least, some of the headwinds to productivity and potential supply shocks tend to get overstated. One in particular, I don't think that you've mentioned, but I hear from many others, is quote unquote deglobalization. And I don't think that's the right characterization of what we're seeing in the world today. I think what we are seeing is a reprofiling and a rebalancing of globalization away from China. And this kind of gets into some of the observations that Don was making, that if you go to other parts of East Asia, if you go to India, my goodness, if you go to Dubai, if you go to Mexico, even here in the United States, where FDI inflows as a share of global FDI is rising and rising sharply. It's not deglobalization, but it's a rebalancing and reprofiling of those flows. Now you might argue, well, maybe the first best they went to China. I'd argue maybe, but that the delta in efficiency is very small at this stage, and you kind of go to a different mix of capital and labor, and the global economy, I think, as a result of that, is likely more resilient to shocks rather than less resilient. And Bill wants to make a two-hander, and for old time's sake, I'll defer to you. Go ahead.
Thanks, Nathan. Bill?
I just make the point that I agree with you that there will be a strong element of reglobalization and friendshoring and homeshoring. But the point of the matter is that if the general supply potential is going down, whether it's demographics, climate, whatever, and the investment demands are going up, okay, short-term granted, but to make that transition, then we also have a near-term inflation problem arising from that.
Okay.
And virtually all of the things that you can think about that reduce supply, at the same time, they're crying out for an increase in investment in order to offset the implications of that reduced supply. More capital, less labor.
And in order for my argument to pro-productivity over the next 10 years to go through, I need that actual effects of climate change don't derail us. And you pointed out, well, maybe that's something we need to be cautious about. But I think we probably have 10 more years where it's not going to be the first order driver of annual macroeconomic productivity performance. And then the response to it in terms of investment, which is also significant. It seems to me that there are some parts of the world, particularly parts of Europe, that are taking it seriously. But the lion's share of the rest of the globe, I just don't think we're doing enough investment that it's likely to have an appreciable effect on, say, real rates out there, because we're consuming so much capital in investing for climate change. So in any event, when I put it, I do take the point on demographics. And when I think about the long run, I kind of think of it as a horse race between aging demographics and AI. And I think the AI is going to win. And it worries me from a sociological, psychological perspective, what that means. But I think the technology is likely to be powerful. And let me just very briefly as well kind of comment on some of the points that Don was making about China. I think that's absolutely right, his assessment that it's gloomy. And I think this is a reason why the authorities have been willing to kind of shift gears and lean now into more stimulus. Clearly, President Xi and his colleagues did not want to, but the economy really has disappointed. And I think one of the reasons why we've seen that disappointment, particularly in the consumer sector, is because the consumers are looking to the future. And it doesn't look promising. And when you have an unpromising future, that's not a good basis to support consumption today. And I think those challenges, high levels of debt and leverage, real estate market that I know Desmond mentioned, big question, Don touched on this, what is going to be the driver of growth over the medium to long run? They played through trade and infrastructure and property. Now they're talking about new wage manufacturing. The problem with that is if that's going to be a driver for the economy, they have to have access to global markets. And even the Biden administration put tariffs on many of that high-tech Chinese products. We just this last week finalized tariffs on Chinese EVs from Europe. I just don't think they're going to be able to get the scale for that to be a driver. Ultimately, the answer's got to be the consumer, but they just haven't figured out how to make that happen. Aging demographics. And then finally, I touched on this. I think that the geopolitics are taking a significant bite out of Chinese economic performance through sentiment, through reduced interaction with the rest of the world, through reduced access to technology. I think that is having a first order effect and contributing meaningfully to that gloom that you described, Don. Finally, let me just ask a quick question here. I'd love to hear Don's reflection on the following question, which has bedeviled me over the last few months. And that is, in this cycle, the Fed was able to go to 5.3, and the economy continued to perform well. We eventually saw some slowing, and that necessitated an easing of policy, which we're in now, but very resilient economy. If I think back to late 2018, the Fed took the policy rate to 2.25%. And the broad assessment was that was too much restraint. And Powell was back with his mid-cycle adjustment and took rates back down to 150. So that would have made me think that maybe 2.25 might, if anything, been higher than where the nominal neutral rate is. And then we've got this 5.3 in this cycle. How do we interpret these two episodes? And what does that tell us about the neutral rate in the United States?
Thank you, Nathan. And 5.3 on a historical basis isn't high at all. It's sort of an average rate.
Higher than
Don, I'd like to give you 1 to 2 minutes max on that. And then Desmond is waiting his turn. And then we got some questions from the audience I want to get to.
I think the 2010s were a different period. There were people rebuilding their balance sheets after the global financial crisis. The savings rate was generally higher. There were flows into the U.S. So I think and worries about secular stagnation. Remember that? About lack of demand. Now we've got. And we had big deficits because of the tax cuts in 2017, but the accumulated debt and deficits, as Alex or somebody pointed out, of 7% at full employment. So we've got more government stimulus. We have more investment demand, partly from government subsidies and partly from AI that you just talked about. So I do think it's reasonable to think that equilibrium rates are higher now. I don't think they're 5.3. The other point is part of the drop in rates in 18-19 was because of the tariff wars. So I do think if we get back into tariff wars and the uncertainty created by those wars and the disruption created by those wars outweighs the price effects, we could be back to lower interest rates. But absent that kind of thing, I do think we're not going to drop back there. We'll be higher.
Wars are great for deficits and inflation, needless to say. Desmond, comments on the panel from you.
Yeah, really, there've just been a whole bunch of interesting points made. I would just say that I agree with Nathan. I think that on the supply side, there's reason to be more optimistic than Bill. I think that this whole artificial intelligence idea, 3D printing, robotics, all of that, it looks to me like technology is moving at an incredibly fast pace. When I see estimates of McKinsey saying 300 million people across the globe could be losing their jobs, that you've really got to take that seriously. just on the point of deglobalization, we could be on the cusp of Trump putting tariffs 10 to 20% on all of our trading partners, 60% on China, 100% on Mexico, etc. To think that that's not going to lead to deglobalization, you're not going to have retaliation, that could be a real shock to the economy. We could find that out in it's just probably a little over 4 weeks. Just on Bill's point on the interest rates, I think that we've got to take into account that interest rates were jacked up from 0 to 5.25%. I mean, that was a pretty abrupt increase. So if the Fed maintains that, that could bring on a financial crisis earlier. How is this commercial property bubble supposed to be resolved? How are the banks supposed to get rid of these mark-to-market losses? If the Fed is bloody minded in this and doesn't bring down interest rates reasonably quickly, you could have that financial crisis occurring. I can't resist mentioning Nathan said that if we get a soft landing, Powell should be in the Hall of Fame. How about his being in the Hall of Shame for allowing inflation to reach 9%? That he had something to do with. You let the money supply increase by 40% in 2 years. That it took some doing. One more point is just, I think that Don Reddy raises a question of what do you do, if you're at the Fed right now, and I think that I wouldn't want to minimize how difficult their job is, with all of these forces out there. We don't know how they're going to break. I think that they do have to make some kind of projection. They do have to do what you said Greenspan was doing, make projection and correct, when they find they're wrong. What they shouldn't be doing is they shouldn't be operating like a hedge fund, and every minute, every data print, you change your view according to what occurs. I mean, that just makes no sense to me. You've got 250,000 increase in employment last month, so you changed what you thought a month ago. That doesn't seem to me to be a sensible way to run monetary policy. Just the last question I would want to ask, the panel is, if we do get an oil price spike, if oil does go to $120, $150 a barrel, what is the right thing for the Fed to be doing? I mean, and that might be a question the Fed's going to have to answer pretty soon.
Well, it can take a couple minutes if anybody wants to answer that.
Well, there's a.
You can remember oil price spikes in the past, and we know what happened. Don?
Remembering there was an oil price spike in the middle of 2008, and scholars at American Enterprise Institute telling the Fed to raise interest rates to get rid of that inflation, which I think would have been a very bad move. The ECB did it. So I think in that case, looking through that oil price spike was the right thing to do when the economy was kind of weak. Now, if you get the oil price spike when the economy's strong, then you have the risk of inflation expectations. But I think what they should do is start by, if they think it's just a one-time level change, you're not going to, tight money isn't going to bring that price back down. So I think you try to look through it, but you keep a very careful eye on expectations. And if longer term expectations start to move, then you have to take some action.
Any other thoughts to Desmond's question? Bill?
I just note there's a very interesting presentation that was just made by the new deputy general manager at the BIS. And it plays into, I guess, my way of looking at the world and the worry about supply shocks. And the title is called Monetary Policy is in an Era of Supply Headwinds. Do the old principles still stand? And basically the message is that if you get one shock and you're in a favorable position, you can just what's the word? You can forget about it. You know, that you don't take it into account. That's the way central banks have traditionally responded to these negative shocks, not the positive shocks, but the negative shocks. And she's suggesting, and I think I agree with her, and I think Don has done so too, that if you have a situation where you've got cumulative shocks, you know, it's coming at you from different directions, but just sort of one after the other. And you're also in a situation where, having just come out of a period of high inflation, you know high inflation can come back. Your inflationary expectations are unstable, as it were, to begin with. And so I totally agree with them. These circumstances, you've got to be very careful about supply side shocks and what the implications might be for the wage price spiral. And that's particularly so today, because I think real wages, this was in the BIS's annual report in the summertime, real wages in most countries have taken a big hit, you know, coming through the pandemic and the inflation afterwards. They're sort of catching up, but they're still in a place where there's more adjustment to be made. So there's more of a likelihood that people will, you know, the wage earners will get more demanding. So I sum it all up with, I agree with Don.
Very good. Let me turn to, we have two questions from Professor Piroska Oaxi, I guess the name is. I hope I got that right. And let me take the second one first. We have touched on the quantitative easing, the expansion or bloating of the Fed's balance sheet and going on to 2021 and 22. His one question is, some of the belated central bank actions may relate to QE itself. What's the panel's overall assessment of QE and its overall accompanying forward guidance with hindsight? What was good, what was bad, was it a success, a failure, looking back now?
So I think, Alex, we've already discussed this to a considerable extent. So I think QE is an appropriate tool to be used when you can't lower interest rates and the economy is weak. And you can take some of those risk premiums, term premiums, out of the long end of the yield curve and try to stimulate the economy. And it'd be irresponsible not to engage in QE under those circumstances. But I do think the Fed could have done a better job. I think it's really important going forward. And I've seen several papers emphasizing this over the last couple months, including one at Jackson Hole, that you distinguish between the market functioning QE and the monetary policy QE. And I think they kind of morph from one to the other very gradually. And if they'd taken a step back and said, okay, we had to stabilize these markets in March and April and May, now we're focused on monetary policy, it might have been a smaller amount. And I also think he asked specifically about the communication. And I think the communication of, we have to stop buying before we raise rates. We're going to give you warning before we're even thinking about stopping. Then we're going to give you warning that we're stopping. Put a lot of inertia and frictions in the response to what was a developing bad situation. Now, if they'd started raising rates a couple months earlier, it wouldn't have made a big deal, I think. But it would have taken a little bit off, and it might have promoted a faster return to price stability than we saw. But I think that they need to look carefully at that experience.
Thanks, Nathan.
Alex, I think that another angle on this that's complementary to what Don had said is assessing the medium to long run implications of large central bank balance sheets to result from the QE. And I think Don's answer focused very much on the impact of fact and the support that it gave to the economy, which is desirable and helpful. You think about rates policy, central banks have been doing that for many decades. You think about balance sheet policy and using the balance sheet as a tool in this manner. It's not even clear to me that we've lived through a complete cycle of that yet. And this kind of gets into your introductory question of, the Fed's booking losses on its balance sheet. To a first order, I think that most economists would say, well, isn't that interesting? And we watch it, but would be skeptical that it has first order implications for the economy, for policy, for credibility. It's more a curiosum than anything else. But honestly, I'd like to see some cycles of QE and QT. And how does the economy work when central banks have large balance sheets? Are there some risks associated with having all that liquidity out there? And I think, again, to a first order, I'd say, the central banks have tools. But I'd like to see some cycles and get a little closer to Friedman's long run on this set of tools before I'd make a final evaluation, and maybe to call in again the Zhao and Lai kind of thing that we're still waiting for enough information.
Take this up when it's less too early to tell, perhaps. Bill.
Yeah, one of the things that worries me about QE is the way that it plays into my worries about fiscal dominance. So that, there's been a significant sort of shortening of the duration of the duration of the assets. And what that means is that when interest rates have to rise, that feeds back into debt service, and creating that kind of vicious circle that ultimately leads to still more going back into the central bank. So the shortening of the duration, you're basically sort of taking out long-term bonds and replacing them with overnight money at the central bank, which is ultimately a liability of government, a joint balance sheet. So that worries me. The short duration.
It means when the interest rates rise, the deficit is a lot bigger than it would have been otherwise because the debt service is higher.
That kind of compounding positive feedback network is enhanced. The second thing is just sort of the way that it looks. I hear lots of people commenting on the fact that the increase in the size of the central bank balance sheet in a number of countries has not been far off the increase in the deficit. And so you basically say, well, the central banks have financed it once. Why wouldn't they do it again? The third thing, I guess, is, and Nathan's already mentioned it, the central banks. And you say the central banks, well, they will somehow prevent this vicious circle from happening by raising the interest rates and stabilizing expectations. But the point is that if you've now got a reputation for incompetence because of because of the losses, and I'm not saying it is incompetence, I'm talking about the way it appears, to have lost all this money. You put all of this together, and there really is another element that you should have to consider when thinking about the usefulness of QE. Because I can tell you one thing, Nathan, talking about, that we have to look at successive cycles of tightening and easing. One of the things that we know for sure is that we never see fiscal tightening that's anywhere near as much as the fiscal easing that we had during the downturn. Okay, that's Desmond's shocking chart. When the fiscal deficits, when your stock of debt is getting bigger, it's more and more incumbent upon you to try to cut your deficit and get this thing under control. And it's going in the very opposite direction. I might say it reminds me a bit about climate change, where we have to cut emissions, but every year the emissions just go up. So, these are considerations about QE. And the last point that I would mention, and this, they just had a recent spike apparently in the repo rates, and people worried about, has the Fed got control? You had to change the operating system. Okay, the operating system in the old days ran off scarcity. The only reason why banks held reserves was to cover clearing losses expected, during the averaging period. Well, that's all changed. And as far as I can tell, there's a lot of people that are worried about it being significantly less efficient than the old system. So there's a lot of things to take into account when we start thinking about an evaluation. So, and I won't get started
And
guidance because I'd go
we'll
on
see.
even longer.
My own view is the historical verdict. Of course, historical verdicts also change over time. We keep reinterpreting the past. The historical verdict may not be that positive, I think. We have a second question, just in a few minutes left, and it is emerging markets started monetary tightening a year before the Fed and other advanced countries. Were the Fed and the other advanced countries behind the curve relative to them, or what comment would we make of emerging country central bank behavior versus advanced country? We have to be quick on this one.
I'm happy to say a few words on this. As we were going through that episode, the narrative that I articulated was, inflation was rising everywhere, but the emerging market central banks didn't have the luxury, and if you will, the institutional credibility to be able to look through the inflation shock. It was actually as inflation was rising. And it ended up that their response was exactly the right one. And I think that as a result of that, they have gained additional institutional credibility. They got earlier traction on inflation, and it's put a number of the central banks in the EM world in a place where they've been able to start cutting rates before many of the DM economies, and more broadly has meant that EM has been fairly well positioned to weather this DM central bank hiking cycle. So it is a remarkable example of EM institutions really rising to the challenge, and you see the benefits in the performance in many of these countries through the cycle.
Thank you. Any other comments on that? Okay, we're down to a last, Bill?
I just mentioned, following up on what Nathan said, is that those countries knew they didn't have credibility and they had to respond. Whereas the advanced market economies thought they had credibility and then found out that they were actually on the cusp, but perhaps not. So we have to be very concerned about these problems coming down the road. So as Desmond would put it, we got to be preemptive here. And we have to try to forecast. And whether I would prefer that we do the forecast not in terms of a mean, but in terms of scenarios. But that's another issue.
Okay, Bill, I'm going to take that as your parting shot. Don, any brief comments to wrap up? Nothing? Nathan?
It's been a pleasure. I could think of a lot of things to say, but maybe the most appropriate is thank you. Appreciate it. And thanks to AEI.
Thank you. And the last word goes to Desmond, our organizer of this excellent discussion. Desmond?
No, it's for me really to thank the panel. I thought that was a great discussion. I at least have learned quite a bit from this discussion. And I think that I've laid out a whole bunch of things that could happen the next year. Hope that they don't happen. But I think that one thing that should happen is that in 6 months' time, this panel should reconvene to figure out, how uncertain it was, and to take stock. Hopefully, it's not to pick up the pieces. Hopefully, it's to thank the lucky stars that we were spared something catastrophic.
I think it's a great idea, Desmond, and many thanks to all. I thought it was a terrific discussion, and we are adjourned. And thank you on the Zoom call, all of you who are with us. Thank you too.
Thanks to Desmond, and thank you too, Alex.
Thanks. Okay,
Desmond, thanks, Alex.
Okay, look forward to seeing you in 6 months.
Okay.